I think actually that military or terrorist shocks in history have historically impacted headlines more than bottom lines, since the effect typically dissipated quickly as investors concluded that it would really not have a material impact on the global economy. In the 1 to 3 months after the fall of Saigon on April 30th of 1975, the S&P 500 gained 4.5% and 2% the 1 and 3 months after. So it was positive. And not surprisingly, the aerospace and defense sub-industry did very well, up 15.5% 1 month later, and then 26% 3 months later. So basically, it showed that there probably was an investor interest into those areas that might benefit from America's embarrassment by losing the control of South Vietnam. I don't think that investors will be selling the market in general, worrying that there will be some sort of terrorist activities going on, but rather it would be more specific towards sub-industries that would benefit from increase in cyber warfare, in your traditional aerospace and defense and armaments, etc. So anything that could help protect the U.S. from these kind of terrorist activities will probably see a lot of investor attention, but I don't think it's going to go into reverse and cause investors to move out of the stock market. Well, Afghanistan has been a hotspot for military interventions since the late 1830s. So this is really nothing new. It is also not a big oil producing country. It's not connected to the Straits of Hormuz, so it would not be interfering with the distribution of oil from OPEC. So my feeling is that it's likely not going to have an impact on energy prices or the price of oil in particular. It just has more to do, if you will, with the self-image of America around the globe. Well, first it was the English who were bloodied in Afghanistan, then it was the Russians, now the Americans. If the Chinese want to try it, then I think they'll find a similar outcome. As it relates to the U.S. Treasury, however, investors buy treasuries because they are looking for a secure, transparent place in which to park their money. Because of the decision by the U.S. to no longer be involved with Afghanistan after 20 years has nothing to do with the Treasury and the U.S.'s ability to pay back its loans. So I think it has absolutely nothing to do with the change in the yield on the 10-year note and whether investors will be interested in investing in U.S. Treasuries going forward. I don't think the Fed looks to geopolitical activities. In fact, they attempt to strip them out. People always wonder, why is it that the Fed looks at core inflation, meaning X food and energy? Well, one reason is the Fed cannot control the weather. So it does not look at changes in food prices, because one year while food prices might be up because of the weather, there will probably be over planting of that scarce good so that you have a surplus the next year. As it relates to energy, well, since it used to be that more than 50% of America's energy needs came from OPEC and other countries outside of the U.S., the Fed did not want to focus its policy on a commodity where the spigot could be turned on or off by those countries who are less favorable to ours. So I would tend to say that no, the Fed is going to focus exclusively on internal core inflation as well as employment. I think the speed with which the COVID Delta variant has entered into the investor psyche as well as into hospitals, et cetera, is of much greater source of concern than the fall of Afghanistan. I think that we can see already in industrial production, we can see already in employment data, and also looking most recently with consumer sentiment, that it has had a depressive effect. So unless we get more and more people vaccinated, then I think that the Delta variant will continue to present a problem, especially if it morphs into another variant that we have to contend with.